In this video, we'll be taking a look at the new supply and demand strategy that you can start using today to start seeing instant profits. So before we look at the new supply and demand, let's review what the original supply and demand is. So usually when you mark off supply and demand zones, you would look for a break of structure and then a retracement to the zone before you get into the trade. This right here, I have a demand zone as an example. This demand broke structure, then came back, and then we would get in this area right here for the entry. Here is another example of this happening for a demand. We had this demand zone marked off. This is the last selling candlestick before the buyers came in and pushed price higher. We broke structure, which was right here, and then once price comes back to the zone, then we start buying. Stop loss goes right under the zone or any other type of entry model you have, and then we aim for higher. That is the original supply and demand. Now, some of the problems that I see with old supply and demand zones nowadays is that it only really works well with a higher time frame, that being the 1 hour or 4 hour. There is a lot of manipulation as well. You will see a candlestick run right through a zone and then take liquidity before going in its favor. And then there are too many zones to keep track of. Now, our new supply and demand zones are going to utilize these three important factors: time, liquidity, and fair value gaps. For this new supply and demand strategy, I need you to go to your indicators box and type in sessions. Session-based liquidity is very important to this strategy. Now that we have our sessions off, next thing I will be explaining is time. So for time, we want to wait until London or New York session before looking for supply or demand zones. So right now I am explaining time. So during London, if we are trading London, we want to see a sweep above Asia high if we are looking for a demand zone. Why do we want to see a sweep above this Asia high? It is because Asia is a consolidation, which means there is liquidity resting right above the highs and the lows. Since we are buying, we want to see a sweep right above the high. So during London, we get that sweep, but we just don't get in because we are trading supply and demand. So during London, since we are trading London, we wait until we tap into this supply and demand right here. Now, before we get back to the video, I just want to let you guys know that I am running a free giveaway inside of my Discord once we hit 1,000 members. Inside of my Discord, I give out free signals and trade recaps every single day, and it's just a community that you can learn from, talk, ask questions, and overall become a better trader. So if that all sounds interesting to you, link is down below inside of the description, and let's get back to the video. Now, why are we waiting for this specific supply level before getting inside of this trade? We wait for this specific supply level because if you look very closely, we have a gap. Right between these two candlesticks, there was a gap right between this supply level. All the rest of these are supply zones. This is a supply zone right here, and this is one down here as well. But as you can see, next candlestick filled in the gap. Why are gaps important? Gaps are important because those serve as imbalances inside of the market. So then we wait price to come back up, tap and fill in this imbalance, and then we get in, and then we aim for lower. So while our old supply and demand didn't utilize time or sessions, our new supply and demand utilizes both time, liquidity, and a fair value gap or an imbalance. Here is another example of this happening. You can use this on any time frame to find your supply or demand zones. The main thing that you want to look for on any time frame is just a gap in the supply or demand zone and price coming back and tapping into it. I've seen that the higher the time frame, the more likelihood that the trade will play out. But the main thing you want to look for is that supply or demand zone with the gap and also liquidity being swept. So in this example, we have both Asia high and Asia low. During London, what do we see again? Right here, we fill in this gap. Even though we don't fill it in fully, a lot of the time, sometimes the gap does not get filled in fully. But what we want to see is price tapping back into that gap and sweeping liquidity, which is right above Asia high. After we see that, we get into the trade right here. We aim for our required risk to reward, and then we get in. Now here is our next example, but we don't have Asia. Instead, we have London, and we're going to trade it in New York. So for our London, we wait during New York for the liquidity sweep of London high. So during New York, we see that liquidity sweep right into this supply zone. And what do we see with the supply zone? It has that gap. And all these things happen at the same time. So after that, we get inside this trade, stop loss right here, and we aim for lower. See, with this strategy, you can catch some insane risk to rewards and also leave some insane runners if you have if you're trading your own personal account or you're trading a prop firm that allows you to leave runners. The strategy is actually a killer for leaving runners and catch high risk to reward trades. The main thing I want you guys to remember though is that you can trade either London or New York depending on what time zone you are in, or you can trade both. For me personally, I only trade New York because I honestly don't feel like waking up during London. But the Asian sweep is a very high probability model that happens a lot of the time. It even happens more in the London sweep, but I just don't feel like waking up during Asia. But it is a very high probability model. Now these are some additional last minute notes. Remember to use proper risk management. Don't be dumb. Have patience as well with these setups if you're going to trade this version of supply and demand. These setups happen less frequently, which means there is a higher probability of it playing out. And lastly, remember to trade with the overall trend of the market. This puts more and more probability inside of your favor. So that's it for this video today. I will do a future video where I'm going into the analytics behind the setup, how I approach it every single day, my win rate and all of that. But that's it for this video, and I'll see you guys next time.